to the Treasury Select Committee on Wednesday, the 21st of May 2025. We're delighted today to welcome representatives of building societies, having had four of the major banks in front of us yesterday, and we're later on this afternoon going to have representatives of challenger banks. And building societies obviously play a very important role, particularly in the mortgage lending market, and are a real staple of financial life in the UK. And I'm delighted to welcome, from my left to right, Susan Allen, who's the Chief Executive of Yorkshire Building Society, Debbie Crosbie, who's the Chief Executive of Nationwide Building Society, which is the largest building society in the UK, and Stuart Haire, who's the Group Chief Executive of the Skipton Group. So thank you very much indeed for coming. And I'd like to ask John Glenn MP to kick off. Mr. Glenn.
Thank you, Chair. I'd like to ask you about the trade-offs or the attitude you have to growth and regulation. Since this new government came in, now just over 10 months ago, the whole narrative is around what can regulators do to facilitate growth in the economy. When we look at what the PRA and FCA have said to us, Sam Woods says that since the global financial crisis, there's not really much of a dispute over the sort of fundamental structure of the regulatory framework. And the FCA say that, or certainly said in evidence to the House of Lords, that we may have to be comfortable with the idea of tolerable harm. But I suppose all of us are left wondering, what is it that you would like to see that, I assume from your point of view, doesn't lead to harm for your customers, but does allow you to expand your economic footprint in the country? We had one set of answers that focused yesterday a lot on ring fencing, obviously apart from Barclays, but it'd be very good to understand what each of you think. Could I start with Ms Crosbie, please? And it's nice to see you again.
Yeah, hello, Mr Glenn. So we really welcome the government's focus on growth, and I think that there's a huge amount that the building society sector can offer. I think there's a very important role that we play in mortgage lending, and I'll just start there. So we really welcome, the FCA have made a number of changes already, and they're consulting on lots more, and we are very engaged in that, so we're quite optimistic about that. Quite specifically, there is a LTI limit, which basically means that for lenders, they can only lend up to 15% of their entire portfolio on high loan-to-income and loan-to-value lending. And we believe that, particularly because building societies tend to have lower risk appetite, that if that limit was relaxed, and in the case of Nationwide, we do a lot of this type of lending, we're very good at it, and our arrears levels are very, very low. We think that your risk trade-off point is a very easy one to make. So with a small increase in that limit for us, even keeping the overarching macro limit at the same level, we think there'd be a significant opportunity to help first-time buyers getting on the housing ladder. So that'd be one thing. There's a range of other things in the MCOB regulations around mortgage lending. For example, reintroducing for selected cases some interest only, for example, we think would be another way of helping affordability. And whilst the FCA have made some initial strides, we think there's a lot more that we can do in mortgage lending to just increase the amount of people who can get on the housing ladder. So that mortgage lending is one thing. The second thing is, I think more generally, as a lower risk sector, we think there's quite a lot can be done on the capital rules. We are holding significant amount of capital, and also we are in the building society sector also constrained by the leverage buffer regime, and Nationwide is uniquely capped in that way. So without getting into lots of detail, we just think it's time to step back and review for the building society sector the overall capital requirements, and I'm sure my colleagues might have a few more things to say. And then just more broadly, simple and more straightforward clarity on what is expected. Outcome regulation is really helpful, but if you don't fill the void and set expectations, particularly when it comes to the Ombudsman, I think that's quite problematic for firms, including building societies, to interpret.
That's incredibly helpful. I just want to come back on one aspect of that. The sort of stretch target, if you like, or the margin that was placed on top of the base rate for mortgage, testing people's affordability.
Stress rates,
which has been sort of allowed us the sort of comfort through difficult times. And arguably,
Yep.
when interest rates went up a lot, we didn't see many repossessions. Have you done any modelling around the effect of the change that happened could possibly have in terms of repossessions? Do you want to give some reassurance on that, perhaps?
So at the industry level, arrears are by historic standards, they have remained very low post GFC. I mean, they're less than 1%. For the building societies, they're half of that.
Yeah.
And nationwide, we're even lower. So we're at 0.4% of 1%.
Yeah.
So we think there's quite a significant buffer that we could take a little more risk for the right customers in the right way that would not get ourselves into a situation where arrears would result in intolerable harm. So I think there is quite a bit of opportunity before we should be overly concerned. And in fact, the risk of not allowing our young people to get on the housing ladder, I think, presents much bigger challenges for society actually in the future.
Yeah. Could I just ask you also, on the regime you're subject to, and perhaps somebody else would want to comment as well, and you said the leverage regime, so it's the leverage regime. So that so with the big banks, they've got MREL. With the challenger banks, they have the strong and simple, and you're subject to a third regime. Now, the impression we get sometimes from talking to industry is that the PRA can be very conservative in their approach to this. Can you tell us, how you deal with the regulator and what sort of awareness they have of what you want to do in this area and what they've responded to, what you've asked for?
So we do have very constructive engagement with the PRA, as you would expect, and we've actively provided a lot of analysis and data on the change for the LTI limit, and it's been a very constructive engagement. But just to sort of maybe give you some context that might be helpful. So in Nationwide, whilst we're a very large lender, I would consider us quite low risk and very conservative. So in the 5 years post GFC, for the total amount of money that was lost through mortgage lending was under £500 million. I would currently be holding in capital, and there's various different regimes without getting too technical, around 10 billion of capital against my current mortgage portfolio. So that just might illustrate where I think there still may be some opportunity for us to reconsider some of those rules.
Thank you. Could I move to Zalem, please?
Of course, Mr. Gann. Well, maybe I'll just add a couple of points.
Please.
Completely agree with the points Debbie's raised as the priority areas, but I'll give you a bit of colour from a smaller building society on the impact. So if we think, just taking that capital point for instance, if I give you the numbers, Yorkshire Building Society made £385 million in profit last year, but we have CET1, so core equity tier 1, of 4 billion, MREL of 1.5 billion, and our losses last year were 1 million. So that gives you a sense of the capital that's tied up in the organisation. Now, as we look at Basel 3.1 as well, we've obviously got the discussions underway on strong and simple. The challenges will be too big for strong and simple, and I think what we would argue is that we should look at not just scale, but also at complexity. So yes, we're a larger lender, but actually we're a very, very conservative lender, and it's very narrow business lines. We're talking about secured lending and then savings. You're not talking about unsecured or any other type of finance. So we'd really welcome, and we do have good constructive conversations with the regulator, but we'd welcome continuing that theme on, is it about scale or is it about complexity?
Yeah, I always get that you have constructive conversations. I would have said the same when I was sat there. But the point is, the question is it getting to the outcome that you need in the scale that the government want it to get to? Because what I hear from when I talk to different banks is that some of these conversations about sort of bespoke arrangements can go on for years before there's a resolution over a switch in the capital requirements. I want you to be candid with us because we want to help you with trying to find the right conclusion.
Look, I do think we've had good discussions about strong and simple, but I think there is more to go in terms of complexity. But also I think it's for us to make the point and to provide the evidential data to help that.
Okay.
On other areas, I'd also pick up LTI as a really important consideration for us. As the building society sector in particular leans into first-time buyers.
Yes.
And the LTI constraint today, the 4.5 times, no more than 15% of your loans, is stopping us lending. Is absolutely stopping us lending.
Certain parts of the country, it's a massive constraint.
In certain parts of the country, it's a big constraint. But when you think about today, that the average, I think the ratio between average salary and average house price is 7.2 times. So 4.5, and actually we are a really thoughtful and careful lender. Of course, we have to be a responsible lender. We're going to make sure that we're lending to people in a way that they will be able to repay. It's not in our interests or theirs to do anything that's irresponsible. We think there is scope to move that 4.5. And to give you again some numbers, our modelling would suggest that if we move that to 20% rather than 15%, just for us, that would unlock £500 million that we could lend, which on average mortgage sizes is another 2,000 people helped. So we think there are opportunities, very specific, focused opportunities that would make a difference.
Thank you very much. Mr. Haire, from Skipton's perspective, is there anything you'd like to add? You don't have to repeat.
I won't repeat. LTI and capital levels are really the two key areas which can actually help unlock and enable much more home ownership, which is something that we are passionate about. I would just add one further thing, which is, you will all recognise this, but I think it's worth saying that as mutuals, if capital levels were improved or lightened, then that would be transmitted directly into the economy. It is not paid up in a dividend or a special dividend, etc. And so as a transmission mechanism of policy intent, you can get an awful lot of bang for your buck by actually helping the mutuals with the simpler business models, with the lower risk business models, to the tunes of the multiple hundreds of millions of pounds. The same is very true for Skipton. So the more that we can do to just offer differentiation on the LTI limits, and the more that we can remove the always upward movement in capital. And our numbers at Skipton is we're holding 3 billion of capital, and our losses last year were less than 10 million, actually less than 2 million. And we have some of the lowest arrears rates. And so therefore there is a lot of pent-up demand before you even reach a point where you will have people, you will be running the risk of underwriting people who might not be able to afford it.
So your conservative lending practices can point to historic, very safe positions, and therefore you need more freedom to hold less capital and so you can do more with it.
Yes, and directly transmit it rather than necessarily paying a dividend up.
Thank you very much. Thank you, Chair.
I think you answered some of the things I was considering in that you obviously have a really important role. I should declare I'm a Labour co-op MP, so I'm very heavily leaning into the mutual sector. But we know that you've got, as you've highlighted, some of the different regulations, and you've given some answers there to Mr. Glenn about what you would like to see differently. The government has pledged in its manifesto that it wanted to grow the mutual sector. So how could that, actually, to just be clear, I should quote it, to double the size of the UK's cooperative and mutual sector? Given we saw the carpetbagging you've all had to consolidate over the years, do you think that's possible with building societies? And if you can answer and allied to that, what does the government need to do to help the mutual sector grow? You answered some of that really in answer to Mr. Glenn, but if there's anything else you want to add, perhaps I'll start with Mr. Haire and work along.
So I think it's possible. It depends really on the base metric of what you're doubling.
Yeah,
and I don't think there's been 100% clarity on that.
Government's manifestos aren't always written in a way.
But if I was to give a compliment to my frenemy, my competitor on the right, of course what Debbie's done in the transaction to buy Virgin Money increases the size of the mutual sector, and we welcome that. Similarly with Coventry and Co-op. But the organic opportunity really comes through if we can make better use of our capital levels and if we're giving a little bit more freedom on LTI. So it goes back to the former question. Also, having proportionate regulation. Now, what that means is the regulatory handbooks are effectively applied universally, whereas our business model, Ms. Allen and myself are very much savings and loans providers. But we are captured by every other piece of regulation. We need to do gap analysis against it. We need to do regulatory returns against it. So proportionate regulation would also help us to free up things as we go forward. So I think there are steps that can be taken, again under the recognition that any sort of capital relief is not for the benefit of the colleagues or for shareholders. It really has to be then used as a transmission mechanism to grow the sector and help more people.
Thank you. Ms. Crosbie.
So, look, I agree. I mean, I think it would be really helpful to the building society sector and doubling that mutual sector if the Building Society Act was regularly reviewed. We were delighted with the work that was done last year by Julie Elliott MP to change some of the nature limits. We are working closely with Treasury. We're hopeful that secondary SI will be laid soon, so we can move forward on that front. That's a key change for us. And the other important thing to remember is for building societies who do have an appetite to grow, and particularly for Nationwide, we're very excited about the opportunity in SME lending. At the moment, 75% of our asset base has to be retail mortgages, so that's not a constraint for us at the moment, but it could be in the future, and I think there are other building societies which I think that would be a really interesting area to address. And there are other small things in the building society. For example, there's a couple of products which we are prohibited from providing, and they would be really helpful to support SMEs in their cash flow lending, which at the moment, so I think reviewing the Building Society Act regularly, making sure that it kept pace with any changes to the Company Act on a regular basis would be really helpful.
Thank you. And Ms Allen.
Well, I won't duplicate anything. So I think the only other things we'd say is really to have consideration of mutuals as part of policy making, and to consider how mutuals might be impacted differently to shareholder-owned businesses, because there are some examples. And I think making sure that mutuals are considered in mission boards or councils. It's a disappointment that there's not a mutual representation, for instance, in the Financial Inclusion Council, because I think we could add value there. So I think it's that consideration of mutuals as a different business model, and which might be impacted differently by legislation.
Do you think there's a prospect that there might be more building societies emerge? I mean, I've talked about you amalgamating, and Ms Crosbie, obviously you've grown a lot with the Virgin money. Thank you for the £50. I should declare. We all got that. Anyone with the bank account with Nationwide. But do you think that you would like to be more amalgamations, and that's how you'll grow, or do you think there's any likelihood that more building societies will emerge?
Well, even absent that, I mean, if I look at the Yorkshire Building Society as an example, I was looking at the numbers from 2019 to 2024, and our savings balances grew by 73% over that period. So I think with good products and really looking after our customers, making sure we've got a simple, straightforward proposition, and that's really clear and meets customer needs, I think there's opportunity for us to grow even organically. There is potential for inorganic, but I think there's more potential also in the mutual sector in the organic space.
Anyone else want to add to that?
No, I would say similarly. I joined the mutual sector about 3 years ago, and actually far from being a sort of an archaic of the financial services sector of the past, I actually view it as increasingly relevant. Our membership has grown materially. We grew deposits 15% and then 10%. So the actual relevance of the type of service that we provide, branch-based, face-to-face service, high-quality products, is increasingly welcomed, and it's not just with those towards the retirement ages, it's actually increasingly help people get the deposit for the first time home, etc. So I actually think the relevance of the model is there. I think if we remove some of the constraints that we've talked about around capital, that will help the lending side. And then I think if we can do more to adjust some of the rules around the provision of advice, then we can actually do even more for people in society to help them make the most of their money. And I'm not talking about massive boundary changes or bringing back regulated advice across every piece of the population, but I do think the building societies can play a role there.
Okay. I was going to bring in Dame Siobhan, and then I'll bring in Mr Glenn.
I just wanted to come in. I've never done this. I've been on this committee in this government and in the previous government, and I've never praised the work of any of the bodies of the people who come to give evidence. But I just wanted to thank Mr Haire and his Skipton Building Society, because every time that I read an innovative way of looking at giving young people mortgages, it's always Skipton. So the fact that you're taking into account their history on paying rent as a good understanding that they will be able to pay their mortgage, the way you're looking at those competitive rates for young people. I'm always ringing people in my office when I see those articles into the paper to say, now look, you could think about buying, look at this article. So thank you for doing that. No,
if I may return the praise. I think I'm going to dine it. I better not ruin it, actually. But I'll just say one thing that coming in, I do think the Building Society plays a unique role. It's not just Skipton, to be fair. Yeah, Susan copied one of our products beautifully. So,
There's no greater praise.
Exactly. The reality for us is that has to be our focus, because we're not likely to be doing big remortgage business. We can't compete on price, so we have to compete on innovation and availability. And we're going to try to continue to do that. It's one of the areas where consumer duties also helped, because you look at the issues people are facing where they're not achieving good outcomes, and home ownership in the main is a good outcome, and then you start to challenge yourself, what more can we do?
And
As we go, we're dangerous.
But just to say that again, like Stuart, I committed sector only 3 years ago, and I do think that one of the things in a smaller, simpler business, you really focused on the difference you can make in both mortgages and savings. And mortgages, our customers told us, and people who were thinking about trying to get on the housing ladder said that raising a deposit was the hardest bit, and people who thought they'd never get on the housing ladder. Now, we did launch a product last year which we called a 5k deposit mortgage, because that's what it does, what it says on the tin, £5,000 deposit, and we will lend you up to £500,000. Started on houses, now extended to flats as well. And the stories, and I listened into some of the calls from people who really thought they would never ever have a chance to move out of their rented flat, and maybe they'd started a family and thought this was impossible. And I think it's really important, but because we have simple business models, we focused really hard on what difference can you make on mortgages, and also what difference can you make on savings and help people to build financial resilience. It's a really important role, and I have to say it's sector-wide, from the smallest building societies to the largest. That's what we all focus on.
There's a warm, fuzzy feel. I'm going to now bring in John Glenn. I don't know who's going to add to this or not. But, this is such a rare moment for the Treasury Select Committee, so bask in the moment.
So, as I understand it, the FCA could come back in the first half of this year on the Wealth Advice Guidance Review. And you've spoken about the risks around the principle-based steer from the FCA and the rules-based ombudsman outcomes, which causes there's an ambiguity between them, right? Can we get specific as we can on what you need from that outcome of that review to look like, so that you can be confident in doing more work to where people's level of to investable amount is below what you can charge for, to make it smoother and to default them to better outcomes? Because what we're anxious about is that review is effective and we don't have another motor finance scandal or another scandal in 5 years' time, retrospectively. Is there anything you want to say on that?
Yeah, so I think I should probably pick that up. We've retained regulated advice in Skipton, and we're increasingly trying to provide other forms of advice. If we go back in time to when RDR was brought in, it's fair to say the reaction of the banks and building societies was one of fear. And so therefore you had situations where people would come in and ask a genuine question in one of our branches: should I take a 1-year product or a 2-year product? And our people were scared to be able to even give an answer. I think we have to move away from that, and so that they can give examples of people in your circumstance may do. So I think the more that we can use situations, and the more guidance we're given by the FCA to permit people in your circumstance would typically type conversations, that would be helpful. Also, to make the advice boundary not quite as razor sharp as it is just now. An example of that would be if someone comes in and they do have a fair amount of cash deposit and a fair amount of financial resilience, and they have a lot in savings, it would be perfectly reasonable for one of our people to suggest that they considered an equity ISA, for example, alongside perhaps some of their other cash products. We want them to be able to execute that there and then, rather than having to wait for a regulatory advice conversation or going away with that good intent and not executing on it, or even worse still, going and getting further advice from social media. So I do think we need to have and where I'm hopeful the FCA will come out is they will give some clarity that will provide us enough of a guide to be able to create some rule sets to help train and guide both our people and the tools that our people use. There is the risk that you point to, which is that then in retrospect cases do go to the FOS. The FOS then effectively through their rulings would then create a rule base that we would have to work to. But I don't think we should go into it with that fear in mind. I think we need to step forward positively.
Thank you.
Thank you.
Thank you very much. Just a quick follow-up. I should also declare I'm a nationwide customer and a Labour and Cooperative Member of Parliament. So, Ms Crosbie, you referenced an SI that you need to move in order to move forward. Could you just say what exactly you think needs to change in that and why you think there might be a delay? but I'm particularly interested in what you think.
So look, we had fantastic engagement with the Treasury, and Julie Elliott put the changes to the Building Society Act, which were supported. And there's just a piece of SI which needs to bring into force the agreements that were made in Parliament.
Okay.
And it's about the way that certain funding, it's the way that funding is counted to that 50% limit, which would just level the playing field for building societies and make the funding model for building societies more affordable and more in line with banks.
Thank you very much. And so Ms Allen, you talked about not being part of the financial inclusion task force. Very, very briefly, what are the headlines that you would be putting to that?
I think we actually had no mutuals in there.
Very briefly, what would you say? What are the headlines of what you'd say?
So I think financial inclusion we think is really important. So is financial education. We'd be proposing absolutely making financial education part of the curriculum. We know from research we've done with young people that those small number of young people who can recall having had financial education in school actually feel more confident about dealing with money and more confident that they could deal with an unforeseen situation. And we think there's more to be done to make sure that people are receiving that education much, much earlier and in a consistent way that flows through from primary education to secondary education. We work a lot with citizens' advice, and we're working with them on how we can help people who have come off debt or are coming towards the end of debt relief orders to start to save. We did some research on saving, and what's really clear is that if people can start to save even a tiny amount, it makes an enormous difference to how they feel. People who save regularly feel more positive, they feel more optimistic, they're able to sleep better. And there's a really strong correlation between saving and your sort of mental resilience. And what was really interesting, the research which Bristol University did, is that it's not actually the amount you save, it's the fact that you start saving regularly. So people saving a small amount regularly feel so much better because they feel better prepared for difficult circumstances. And so last year, as an example, in UK Savings Week, for that reason we launched a product which was a £50 a month regular saver aimed at helping people to start a savings habit. And we've given 8% interest rate on that, and 17,600 people started to save. So these are some of the ideas we bring into financial inclusion, because it's about increasing access, helping people who are struggling. I mean, when I talk to the citizens' advice, many of the people that they're supporting didn't know that they could open an account, a creditor account, your account in credit, without having lots of checks, and they were nervous and thought they wouldn't be welcomed by banks or building societies. So there's a lot we could do to dispel some of those myths and to help people to start to feel more financially resilient.
Thank you very much. Financial inclusion minister, I'm sure she'll, if she hasn't heard it right now, we'll pick up what you said. Just one from me before I throw to Mr. Coughlin is that we've got this pledge by government to grow building societies, and it's not always the case that bits of government understand the mutual sector very well. Is there any key area, you obviously deal with the Treasury a lot, but and the Bank of England and others, but are there any other areas of government where you think there needs to be more understanding of what mutuals can offer? We'll start with Ms Allen or whoever wants to.
Well, there's a very effective APPG, and we get really good engagement. The Treasury officials, I think, are excellent, certainly engaging with me personally, and I know my two colleagues as well. I think it's this, always having a building society sector in mind when everything else is done in financial services regulation, but I find the engagement with the Treasury very, very constructive.
Okay, but you don't have to all be nice to them.
No.
If there's something you want to say.
Genuinely, the Treasury officials hugely engaged and really good at reaching out, actually, to either me personally, to my colleagues for data, for
Mr. Haire, you wanted to say something?
Yeah, I would probably add one other department where I think we can further the engagement, which is with housing. We ran a parliamentary event pointing to some of the challenges on the affordability of housing, and obviously a lot of the focus is on supply there, quite rightly, that's where that would sit. The challenge is that supply will only happen, yes, once all the planning reforms, etc., go through, but also there's a consistency of demand. And therefore, being able to create a housing system whereby there is more flow into first time and then through the different stages of home ownership becomes really important. So helping them to understand that, so that it's not just a supply dynamic as they look at the housing mission, it's also a demand dynamic into that as well. We're keen to continue that dialogue.
Okay, and for the record, Ms Allen's nodding, so we'll take that as agreement.
I'm in agreement.
Thank you very much indeed. Chris Coughlin, MP.
Thank you, Chair. Mr. Haire, so we're seeing in the latest monetary policy report that household saving rate is increasing, potentially due to precautionary saving. The bank's credit conditions survey said that unsecured household borrowing is rising. What's driving these increases? And are you seeing any notable trends in defaults or arrears?
So we're not seeing any notable trends in defaults or arrears yet, nor are we seeing... One of the interesting phenomena was when interest rates went up, and so therefore you had people remortgaging on their house, ultimately the costs of that remortgage would go up as well. What we put in place was an awful lot of forbearance options for customers so that they could cope with that and hopefully that peak before it would come back down. They also didn't then result, when the forbearance option finished out, it didn't then result in a whole load of arrears. So there is resilience in those people who have been lent to within the market. What I would say, the first place that you would typically start to see issues of credit would be in the unsecured space. So it is notable that more use of unsecured often leads to a statement where the financial resilience is being more challenged. On the savings side, people are being more cautious. Ultimately, they are making sure that, and we see that in our own saving stats, the M4 stats, and across the building societies, we are seeing people put more money away, but they're also having to put more money away when they're younger to be able to afford the deposit. So saving habits have changed a little bit. When interest rates were next to zero, the saving incentive was less. We are starting to see people put more away, and we also, interestingly, and I know this isn't necessarily the topic that we're on just now, as speculation grew about cash ISAs, we saw record cash ISA seasons. So they are a very, very popular product, and one which customers want to use.
And Ms. Allen, I see you're nodding, so we're tight on time. Are you seeing similar trends?
Yeah, absolutely. I mean, I think particularly as we all see the stats, the industry stats in terms of cash ISAs, it's been a very strong year this year. And I think you're right also, Mr. Haire, that as interest rates have gone up, people are becoming more active in managing their money. We certainly see that. We and the building society sector have actually been beneficiaries of funds coming from current accounts into savings accounts because people are recognising the opportunity. But there's still something like £360 billion sitting in accounts earning less than 1% interest. So there's still an opportunity for people to manage that money more closely. But we are seeing people continuing to save. I think what was described as the COVID bounce was I think kind of shocked a lot of people into that savings habit, and we are seeing that continue.
And Ms. Crosbie, how are you seeing wider economic developments such as global trade uncertainty and US tariffs affecting your business customers?
So for us as a domestic lender, the impact's very limited. We do have an SME book under Virgin Money, and the impact of that has been very muted to date. I mean, we're seeing similar trends that you've heard. Despite the obvious challenges, lots of resilience in both. We're an unsecured lender as well as a secured lender, and we're not seeing a change in those arrear levels. Interestingly, we have also had the busiest cash ISA season I think Nationwide's ever had. And one of the things I think might be interesting for the committee to know is that 40% of our cash ISAs this season have been written in person in branch. I just did want to underline we are still seeing the very great importance of being able to offer face-to-face branch services. It's incredibly busy. 30% of our new account openings, that's current account openings, are also in person in branch.
Thank you.
Thank you very much. Done?
Sorry.
Thank you.
Sorry.
Dame Siobhan.
I just want to look at consumer duty and at how it might be impacting you. You made a reference earlier about it making you look at what sort of mortgages you're offering and to who. So I just wanted to ask, how generally has the consumer duty changed how you do things?
That up if I may. So one of the things that it's done is it's given an impetus. Maybe if I take a step back, the mutual sector is owned by its members, and so therefore you'd like to think if there's ever going to be a sector that is customer focused, it would be the mutual sector. But what it's done is it's pushed us out of being complacent about that statement and actually brought some precision into things. So what does that mean? We've had to dramatically simplify our T's and C's so that people fully understand them and get them tested by experts. Materially increase the level of training we have about different vulnerabilities, for example neurodiversity and people's ability to understand the products that we're giving them. But it's also meant that we've probably had a deeper scrutiny on some of our historic practices. So for example, a legacy product that we had offered a discount if someone set up a direct debit on a mortgage payment. Now that's now common, yet there was still this discount, so we now offer that discount to everyone. So there were things that you just almost by osmosis you keep running with, and what Consumer Duty bringing in was a fresh lens at that. What I would also say, the example I gave earlier, is it's allowed us to really think through an outcome lens. What's stopping potential customers being customers, and is there anything we can do there? So we talked about we had a track record mortgage, delayed start mortgage, also some forbearance options that we might not have considered in the past as interest rates went up on mortgages. All of that I wouldn't attribute singularly to Consumer Duty, but I think what Consumer Duty did in the principles-based regulation is it made us all, from the board down, sort of actively reconsider our range and the way that we present products to customers, and ultimately the service they then provide.
Yeah, so look, I'd agree. I think our start point in Nationwide is a mutual-owned organisation. We pride ourselves on Consumer Duty concepts. I think there's two things I'd say. It's really helpful to challenge how you communicate with customers, the simplification of that communication, and the amount of management information that we now provide to our board has certainly increased, and that's allowed our board to challenge us harder and just provide a higher level of scrutiny on the decisions that we make. We also have found some areas like Stuart that it did require a revisit of some of our products. Just one example, we provide now a £50 overdraft buffer, which is free to any customer who's in financial difficulty, and that is quite a significant support to a lot of customers who really need it. And that was an example of us really challenging ourselves again through the Consumer Duty lens. Is there more we could do?
And similarly for us, again, as a mutual, how we look after our customers is absolutely the core of what a mutual is and does, because actually our members own us. But I think Consumer Duty has helped us to really drill into some areas. I would also pick up communication, because we now test our communications to customers, and we test them against a reading age of 13. And one of our quite important documents, when we tested it recently, only had an understanding sort of percentage of 18%. We made some changes to that. We simplified the language. We made sure it was really clear. It retested at 83%.
Wow.
So actually, some of those things, when you think about the importance of understanding the products that we offer, it's really important. We might have thought it was very clear before, but there's much more discipline about really testing the language used in communications. And actually, that's got benefits for our customers, but it also has benefits. It means they're not needing to call in to clarify. So I would say it's given us some really good structure, and like my colleagues, the level of MI we now have around delivery for customers is much more extensive. When I came in and looked at our performance in our contact centres, for instance, we were delivering some inconsistent service, so we invested another 150 new roles to make sure we were delivering really fantastic service, and I'm delighted to see how our NPS scores have improved as customers really value easy to access and swift service.
Any unintended consequences?
I would probably say that, and I might struggle with the specific here, but allow me to just go with a little bit of a sort of theory. When you've got principles-based and you're making a judgment on what a good customer outcome is, it can sometimes operate in conflict with some of the rules, typically around lending. So there may be some construction in the MCOB which basically suggests that there are rules that you should or should not do, but in a customer circumstance, that actually a bit of discretion becomes important. Actually helping colleagues, because this happens on scale, it isn't done in the boardroom, helping them understand that they do have discretion, and then helping people who check or quality assure their work to understand that there is some discretion, that is becoming more and more of a challenge. Things like an affordability check on various different sources of income, when someone already has debt with you, those types of things, using discretion becomes important, but you can't run foul of a rule book. You can't knowingly breach rules. So those types of things, we do need to work with the regulator, particularly FCA, to make sure that we don't, where we find conflicts between the rules and the principles, we're actually naming that and working with them to try to reduce it.
Yeah, I'd just add that I think the Consumer Duty, now that it's embedded, gives us a chance to step back, review MCOB, and CCA is the other one, the Consumer Credit Act. I think there is a layering now of regulation, and I think to support that simple, straightforward clarity that firms need, I think it's time to review those other rules and decide. And I think the FCA is very committed to that. They've engaged with us already to decide what can now be retired now that Consumer Duty is more embedded.
Thank you. James Shaw?
I've nothing to add.
Yeah.
Really.
Oh, yeah. Obviously, as you've made reference to, the consumer duty is an outcomes-based policy. To what extent would you prefer a rules-based or an outcomes-based system of regulation? Should, as the point you made, Debbie, do you think it's all the other rules that are now a bit too old-fashioned and need a bit of change?
So I think this is one of the most challenging areas, and I think we've done quite a lot of thinking about this. I mean, my strong view is that outcome-based regulation has to be overlaid or underpinned by what I describe as minimum standards, and those minimum standards should not be, competition should allow you to go well above and beyond, and I think you'll find lots of examples where people will choose through their various business models. But I do think that unless you can provide firms some degree of certainty that if you achieve these minimum standards, that means you comply with the rule books. If not, people just de-risk, and that's exactly what happened through RDR, where people just constantly de-risk. You then withdraw services, and the impact on the consumer is the unintended consequences where you don't provide services. So I suppose it's a bit of a complex answer. For me, it's outcomes-based regulation underpinned by clear minimum standards, and the collaboration between FOS and the FCA is essential to make that work. If there's space between them, that's when it becomes incredibly complex for firms to navigate through, and I think that's when you get the de-risking.
Anybody?
No.
We've made some reference, but how has the consumer duty changed how you treat vulnerable customers?
Look, I think that, I just repeat, I think it's challenged us to consider processes, procedures. Again, I think we would pride ourselves on having a strong track record, but there's always more you can do. I mean, our view is consumer duty is a journey, it's a continuous improvement mindset rather than a rule book. And, we learn all the time. When it comes to vulnerable customers, increasingly people's lives are very complex, and what you often find is it's not one issue, there's multiple issues that can often be very challenging to deal with. So continuing to work with third parties, third sector, continuing to really think creatively about how you provide that support. The key thing we find is having very well-trained staff. Some of these situations can be difficult for our colleagues to deal with, so providing them with support. Recently we've made sure that where people are on very difficult calls, if there's very high-risk situations, we can patch in real time supervisors in, and we actually on occasion can patch into the call live in some extreme occasions, and other people who can support that very specific circumstance. We've worked really hard at recording of vulnerabilities in line with regulation to make sure that the customer doesn't have to constantly repeat themselves, so that there's a very good record of the situation and the customer feels confident that they're understood. Would be a couple of examples.
I think I would completely agree. I think consumer duty is we're continually learning, but on vulnerability, again, we're learning more and more about how, even through things like the communications reviews, that actually messages will land well for certain cohorts of the population, but then perhaps neurodiverse customers would have a different take on some of the communication. So we are learning and continue to evolve. The training for our colleagues is critical. We've also set up, as I'm sure others have, extra care teams who've got more specialist skills in more complex situations to make sure that they're really equipped and also feel supported to have some of those difficult conversations in difficult situations. But it is, I think consumer duty, our understanding of it, it's really making us think more and more about the different challenges that our customers face and how we can support them.
Thank you very much. Thank you very much, James Shaw. Rachel Blake MP.
Thank you, Chair. Ms Crosbie, you've given some really interesting evidence about ISAs at the moment, and the Chancellor earlier this week confirmed that she wouldn't be reducing the amount that people can invest into cash ISAs. Why do you think...
It was into ISAs as a whole. Not
into ISAs.
Yeah.
Why do you think that statement was made?
So, look, I think cash savings is a really important part of many people's financial resilience. We find that around 80% of our balances are held by people who are either at retirement age or nearly at retirement age, and for a lot of people investing in equities, which is a much longer term, more complex decision, wouldn't necessarily be right. So we think that anything that can be done to encourage the right people with the right advice to invest in UK equities, if it's right for them, is fantastic. But I think it's very helpful to allow people the choice that's right for them. And in a lot of occasions, we find that it's very beneficial for people to have that tax-free option and build that financial resilience. It works very well for their circumstances.
Thanks very much. So we're getting into the advice and guidance boundary, which we've heard a bit about already.
Yeah.
So you want to see progress on moving forward with that review. Are there particular elements to it that you think really need to change?
Yeah, I think it's very difficult for people who are not incredibly wealthy to access suitable advice. And when it comes to things like equity investments, I think that's very important. The level of fraud that we see in investments is a huge issue, and having people well advised, being able to access, in some occasions it may have to be face-to-face advice, in some occasions it may be digital, we think super important. And without that support, I think it could be quite difficult to encourage a very wide change in people's attitudes to invest in equities.
Thanks very much. Mr. Haire, you were talking about some of the advice that you would like to be able to offer at the moment but feel that can't at the moment. What are you doing at the moment to try and get this advice to people?
Yeah, sure. So we retained having regulated financial advisors, and what we were really looking for is a bridge between those people who, in the front of our business, in our branches, are engaging with customers and being able to help more customers with a broader range of needs before the need to refer then to the specialist regulators. So it would be things where perhaps we did identify that someone had enough cash savings and we're at a stage in their life where actually a longer term plan may be sensible. We could offer that and suggest that would be a valuable route, and then allow them to execute that on premise with us. That would be a sensible, in my view, sort of adaptation to the rules. But it would be examples like that. Now, where more complex things, estate planning, tax planning, etc., you have to then still go to the regulated advisor. Their training and the complexity of individual circumstances almost mandates that. But what I wouldn't want to happen, either through cash, ISA review or whatever else, is to start to remove choice before customers have really had the chance to engage in that choice. And that's why the advice and the education piece is really the most important piece, rather than arbitrarily changing limits of one type or another.
So just on that, you don't think that changing any limits would significantly change behaviour?
I don't. No, and we would suggest, actually we have evidence to suggest that it doesn't do that. The amount of people that are aware of equity ISAs, it's over 60% of cash ISA customers are aware of equity ISAs. And so
sorry,
therefore,
just to repeat that statistic also, so only over...
over 60% of customers, there's research that we did, over 60% of customers who have cash ISAs are aware of the construct of an equity ISA, and yet they choose to still stay in a cash ISA. The reason for that quite often is to do with their individual circumstances. They may be saving for a specific item and need access to the cash, or be towards the tail end of their retirement, and therefore they would again don't want to be tying up capital into equity longer term investments.
Mr. Glenn,
Yeah, can I just
very briefly
come back on this whole issue of cash versus equities? I totally get with the age profile when people are near retirement, it will be unwise generally to invest in equities. But I mean, this interacts with the sort of challenge of financial education as well. For people below a certain age,
Yes.
it will be very unwise not to invest in equities. I think, would you recognise that as a reasonable proposition? And whilst it might not align completely with your customer base, we as a society have got to grip that problem, haven't we?
So look, I think that's incredibly sensible, but I think it has to come with, number one, the right support. I think the second issue that I'd really highlight is I think we have to collectively be much more confident in what we're doing about fraud. Investment fraud is such a huge issue, and I think there's a number of things that have to be worked on to make sure that when we reintroduce that for a much larger population, people are adequately supported in the choices that they make.
But if you're tracking the FTSE over 10 years,
Yep.
even on a tracker product,
Yeah.
that doesn't really have a big risk around fraud, does it? I mean, what I'm trying to get at is that there is a reasonable assertion around mass use of trackers and low risk equities, which is far better than the normal rate of return from interest over 10 years.
I think that's right, Mr. Lynn. As long as you're accessing the website you think you're accessing,
Fair
right? As long as you're putting the money where you think the money's going, and we often find numerous examples where that is not the case.
Point heard and taken.
Mr. Haire, briefly.
I think that links to actually providing trusted providers such as ourselves and banks, etc., the ability to then have those conversations. And right now there is that fear which we talked about earlier. So yes, absolutely, there's chunks of our customer base that we do want to engage with to actually help them manage their money more effectively and make it work as hard for them in their circumstances.
Thank you.
Ms. Blake,
Thanks, Rachel.
last one.
Thanks. Ms. Crosbie, I wanted to ask, Nationwide doesn't provide a lifetime ISA product. Why is that?
We don't run regulated advice, and we felt that the complexity of that product just wasn't right for our proposition. We also think there's a few complexities with that product that I think it would be better to consider simplification of it.
Thanks very much.
Thank you very much. Well, obviously, we're just to flag, we're doing an inquiry into the lifetime ISA, which we'll be reporting in due course. Dame Harriet Baldwin, MP.
Thank you very much, Chair. And Mr. Glenn touched on this a bit earlier, but I just wanted to drill down a bit further into the comments you made earlier about your mortgage book and the mortgage losses, because clearly we've gone through, after the invasion of Ukraine and the spike in inflation, there was a period where the bank raised rates very quickly. Have you been surprised by the way in which people have coped with that? So have you found that distress has been lower than expected? Did the mortgage charter help? And so I'll start with Mr. Haire on that.
I think the simple answer to that is yes. We were not complacent going into that period. We put products into live, an example of which was a higher fee product that would be then capitalised over so the repayments were simpler. That wasn't actually taken up terribly much because people could cope. And some of that's to do with the fact in the underwriting the stress rates did exist, and so therefore people had the financial resilience. But we all know that we sometimes grow into our budgets, but people were able to make adjustments, and it did surprise on the upside.
So the stress rates worked, Ms. Crosbie. Is that the experience that you had at Nationwide as well?
So we found much lower arrears than you would expect in times of stress, and we found the portfolio very resilient. Like Mr. Haire, we did have a number of options ready and waiting. Their uptake was limited, and I think it is because underwriting standards, it's not just stress rates, the whole change in sophistication of underwriting standards generally, I think in the market, not just in the building society sector, has moved considerably from where it was pre-GFC.
So I want to seg from that really into the learnings that we can take.
Sorry, does Ms. Allen have something to say on that?
I don't know if there's anything different you wanted to add.
I think the only other thing I'd add to that, because we're exactly the same situation, but one of the things that we found really interesting was obviously with the mortgage charter we made available other options to customers, and that was promoted well, and so we had a number of calls in. What we were surprised by was that once you talked through with customers the situation and also the implications if they did, for instance, capitalise some of their payments, actually something like 60% of them said, well, actually, let me just see, I think I can manage. And so it's been I think the importance of having that human contact and the ability to speak to somebody and talk through your situation is the thing. So we were pleased that people called us, actually quite interested to see that once we talked through the different options, a number of people said, actually, I think I can manage. I just wanted to know there was a choice available for me.
Yeah, that message in the mortgage charter around get in touch with your mortgage lender if you're at all concerned was an important one. And we heard about the inquiry that we're looking at the LISA at the moment, and we heard from the Minister in our evidence that home ownership is obviously a major public policy objective. And so I just wanted to ask each of you if you could pick two things that you would do differently if you could influence the government entirely to achieve that goal of greater home ownership. And I'll start this time with Ms. Allen.
I think one thing is having a holistic long-term strategy on the type of housing available in the UK. I mean, I think they're making sure that we've got the right sort of properties being built for the types of needs we'll have going forward, I think will be one thing. And I think another to try and encourage opening up some of the property that people are staying in later in life would be looking at stamp duty on the way down. So if you're downsizing, looking at the stamp duty to encourage more people to move out of those larger homes and free up more flow in the housing market.
Okay, Ms. Crosbie?
For me, the LTI limit is the number one thing that I'll not repeat. And I would certainly review the MCOB rules. I think there's a number of different ways that we can to support, of course, the supply side. There's a number of different things that could get more people in the housing ladder, and they could be done quickly.
Okay. Mr. Haire?
I won't add anything. Certainly the LTI would make a huge difference on availability of mortgage lending. I do think stamp duty is a punitive tax and it discourages economic activity, so I would have a slightly more wholesale review on that to encourage more transactions in the housing market and make the market more vibrant. Finally, I am a lifetime ISA supplier. Charlotte was here giving evidence to you, Ms Harrison. I think just making that a simpler product to be able to claim upon would unleash a whole load of money that taxpayers have already locked into that product and help more people that have shown the ambition and wherewithal to get on the housing ladder to do it.
Okay.
Is that one very clear?
Yes. On the stamp duty, when I was a minister, looked at this principle of somebody downsizing from, say, a house of 800,000 to 500,000. I think the argument was that if you say you don't pay stamp duty on the 500,000, obviously there's a lot of dead weight costs, because if you've got all that equity. So what was happening was that, if you didn't do that, then nobody would move. But if you did do it, the taxpayer wouldn't be getting a good deal, because you'd be effectively giving relief to somebody who had all the equity. Do you see my point? So the question is, from a rational policy-making point of view, how do you achieve that outcome when clearly the argument is, well, you're wasting money on people who don't need it, but you don't get their behavioural changed?
Yeah.
What do you say to that?
Well, I think just look at the whole thing, the whole system. It's not what that one move in isolation, it's what it then enables. So I think it's looking at the outcomes.
I think it's a big thing to start a debate.
Sorry, I just couldn't resist it, but I wanted to do something. I couldn't for that reason I've just described.
You could see the enthusiasm from the committee, but can I thank our witnesses very much indeed. And as a Labour Co-op MP, it's great to have three mutuals represented in committee today. The transcript of this session will be available on the website uncorrected in the next couple of days, and we are now going to move on to our second panel. So order. Treasury Select Committee on Wednesday the 21st of May 2025. We're continuing to discuss the state of the world with the banks and building societies, and this panel, the second today, is the Challenger Banks. So I'm really pleased to be joined by Raman, Bhatia, who is the Group Chief Executive of Starling Bank, Richard Davies, who is the Chief Executive of Allica Bank, and Mark Mullen, the Chief Executive of Atom Bank. So different types of challenger banks with slightly different portfolios, so we'll be directing questions as appropriate. So I'm going to ask Mr John Glenn MP to kick off.
Thank you very much, Chair. So over the last 10 years, I think there's been about 40 new banks created, but the concentration of customer accounts still resides with five, massively with 5 of them. You're examples of some of those new banks. One of the things that we wanted to try to get to grips with is regulatory burdens. You'll have gone on a journey to get your banking licences. Perhaps firstly you could reflect on how straightforward that was, and then perhaps you could tell us what you feel could be done to enhance the journey to allow you to innovate. I mean, I've visited your predecessor, Mr. Bhatia, in Southampton when I was a minister, and she described it as a technology business more than a bank. But you all have a different sort of take on what you do. But what would be really good to understand is where you feel that regulatory journey has been inappropriately burdensome and taxing, and in the context of what the government are asking the regulators to do, how they could specifically made your journeys easier, and as you hopefully grow, what could they do now to help you through the next stage? Would you like to start, Mr. Bhatia?
Yes, I can. Thank you, Mr. Glenn. As you said, I think the UK regulatory regime, in many ways, is there's a lot to admire. Since the financial crisis, we have had more financial stability than elsewhere. We have had safeguard against depositors, protection of their deposits. We've had financial stability, and we have been relatively unscathed by the potential contagion in other markets. And as you rightly reminded, we've also had a very progressive modern authorization regime which allowed the creation of new banks. And Starling is definitely one such bank. And we have grown quite a bit. We are serving 500,000 small businesses all over the country and 4 million retail customers as well. So we are now at the cusp of growing further, and this is where perhaps there is time to revisit parts of our prudential regulation which are holding our growth back and preventing us from investing our capital into what we do best, which is investing in technology to make our customers' lives easier. A good example of that is the buffer over buffer we have around MREL, which no doubt has come up before in the committee, and this is a requirement to prevent tax holder money around bank failure and bailouts, which we support the principle, but the entry thresholds for MREL are currently set at a very low level. 15 to 20, 25 billion is the entry threshold, meaning once you reach that, then your capital requirements go up. In fact, 2x is where it goes with a glide path, which we think is disproportionate.
So they didn't index the thresholds to GDP. I mean, that was one of the changes they didn't do that you wanted back in a few years ago with the regulatory changes. Is that what you'd like them to do, or is there anything else? And isn't there some ambiguity over the 15 to 25 billion window? How clear are they when it actually hits? Because if you're looking at an acquisition, presumably you'll face some uncertainty over when it's going to bite at a big leap.
Yeah, I think there is a sensible dialogue with Bank of England in such circumstances, but the threshold is very low, and as you rightly point out, the indexation has not happened, and we are calling for a significant increase in that threshold, perhaps in the tune of 40 billion. Right. And there is an active consultation underway, and there's a very proactive open dialogue with Bank of England and PRA on this, so we are optimistic the findings of that would be shared at the end of summer, so let's see where it goes. But it is absolutely preventing us from creating clarity around our capital planning, and then also locking capital up versus deploying it in the service of our customers.
So, do you agree with that, Mr. Davies?
So Allica is about 5 billion of assets currently. We do essentially plan to remain below that MREL threshold because hitting it is quite penal, as has been observed with some somewhat larger challenger banks. So very much do echo what Raman's just said there. I think I'd probably just build on that a little bit to add some other areas and examples. So I think there is good evidence that the authorisation and start-up regime for banks works well, actually, better in the UK than many countries.
Yeah.
I think there's a general theme that there's not been enough attention paid to then the scaling phase.
Yeah.
The MREL is one example, but to give you some other examples around that, we've actually called for there to be essentially a scale-up unit to match the start-up unit. There's not really enough specialist resource available for fast-growing banks, and therefore ourselves, but also various other banks at roundtables regularly report sort of delays around capital processes. And it's ironic, actually, we're saying we want more regulator, and in fact we've actually said we have to pay an increased levy for that because we are recognising there's
So let's
more
be clear,
demand.
we've set up in the UK, I think about 10 years ago, probably Haire did it, the new banks unit, and we've got the regulator looking after the big banks, but there's no body regulator that actually looks proactively with you at this middle stage. So you've set up, got your license, but then you're in a bit of an abyss before you get to, and nobody does get to the big stage. Is that right?
Essentially, so you get your license, there's a sort of training wheels sort of unit period there for a little bit of time, but then once you exit that, if essentially you're going quite well, growing fast, you're successful, I'd say there's industry will welcome more engagement with the regulator, more resource there to help ensure that sort of capital-related processes and instruments are done in a really timely manner. Because the impact otherwise is it just creates uncertainty, and uncertainty is sort of anathema to investment. So if you're trying to keep securing capital, to keep your growth going, to keep your lending to small business going, then that uncertainty, because there's delays around capital processes, it really hurts that. Right. So hence our point, we'd like to see a equivalent of the startup unit for scale-up companies. And as I say, we are happy to pay a levy towards that. I mean, if I can make two other sort of points that I think are often common amongst particularly SME lending-focused challenger banks. One, I think, is, I'm sure this committee has had plenty of talk around the Basel 3.1 implementation over the years. Now, the initial proposals were fairly adverse to SME lending. It's something we were quite vocal on as Allica. The PRA, I have to say, did change that. However, the sort of details of how that's going to be implemented are still waiting clarity, and we're back to this sort of uncertainty position as to
Well, because they don't want to be a competitive disadvantage to the US or Europe, right? I mean, that's why they're holding back.
Well, specifically, the thing so essentially, they're getting slightly technical, and happy to follow up with more detail in writing, but they removed something called the support factor for SME lending, which Europe had introduced. And we're then looking to essentially give it back in a different process via what they called the SME lending adjustment. It's details of that SME lending adjustment that's still pending, and how that essentially offsets the removal of this support factor, which I don't think is attached to the delays in the US or similar. I think it's in the bank.
That would be helpful to write to us on that, because that's detail that we value. Thank you.
Yeah, if I may, one final point, which is we also feel quite strongly about, which is within the sort of capital requirement stack you have, for most SME lenders, a significant part, typically 10-15% of the capital requirements, is really related to the fact you are lending only in the UK. Yeah. And we think that does duplicate with other aspects of the capital requirements that are really centred around credit risk, which ultimately is a function of the economic environment. And it's not obvious how having essentially a penalty for being UK only focused in lending is really aligned to either the secondary objective or the government's sort of mission for growth.
Okay. Thank you. Mr. Mullen, could we move to you? Is there anything you'd like to
agree with in regard to what's just been said?
Yeah.
The point I would make is it's not so much about the permission, it's the permission to do certain things that the regulator has been very prescriptive about. In focusing on mortgages, which is a very big part of our business model, 90% of all mortgages underwritten in the UK are underwritten by 10 banks, and all of those banks have an IRB waiver. Yeah. Which is not coincidental, because that gives them an enormous capital advantage. The average age of those banks is 141 years.
Yeah, and you don't have the data to justify.
We have the data to sort of back this up. So if you're a new bank, we're a 10-year-old bank, and you're looking at, well, is that the qualification? You have to have an age of 141 to get into that club? You'll forgive me for lacking a little enthusiasm or optimism about the prospects of us ever getting there. What's interesting is that if you do get there, and there is a case study from the Skipton Building Society, who were here earlier, but also from the Leeds Building Society, who were admitted to that regime in 2018 and 19, their growth rate is plus 63% over the last 5 years. So a magical thing happens if you're allowed access to that club. Your lending will actually outperform.
Do you want to
nominal
explain
GDP
to
growth.
us what, and to those watching?
Sorry, IRB is essentially a permission that the regulator can grant to you that allows you to use your own models to calculate your capital.
But presumably they would say you have to have a sufficient track record of solvent behaviour to show that you haven't been at risk in that prior period to allow you to go it alone and do it in that way.
Well, it's not going it alone, to be fair, and then equally the market conditions that applied in 1980 relative to the market conditions that have applied now are chalk and cheese. So in other words, length or durability doesn't necessarily guarantee quality or good data.
Okay.
Because frankly the world is not marginally different in those decades, it's transformatively different. So I don't really think that argument holds. The fundamental truth is that if you give people permission to go and expand and grow, and it's permission, incidentally, members, to take less risk. IRB doesn't give you permission to take more risk. I have permission to take more risk. We all have permission to take more risk. But permission to take less risk and to actually grow your franchise meaningfully, to challenge, that is still a significant hurdle.
Okay, thanks. Thank you very much.
Thank you very much, Mr. Glenn. Chris Coughlin, MP.
Sorry, so thanks so much. So the Bank of England noted that in the monetary policy report that household saving rates are increasing, possibly due to precautionary saving. Could you tell me what trends you're seeing in relation to this, and in particular, given that the credit conditions survey is also saying that unsecured household borrowing is rising, what you believe is driving that increase, Mr. Mullen?
What do I believe is driving increase in savings?
Yes, yeah. So is it precautionary, or is it? Are you seeing that yourself or not?
You saw a very big change that was triggered by COVID in the behaviour of savings in the UK, and actually it hasn't reversed.
Yeah.
And equally, the incentive to save today is rather better than it was 5 or 6 years ago. You can actually earn a relatively decent return on your savings, depending upon where you put it. But it is worth advising that loyalty to your bank is generally bad for your financial health. So really, you need to shop around. Because frankly, there is a direct correlation between the amount that you're going to earn on your savings and whether you save with one of the big banks. And the general rule of thumb is they'll take you for granted and pay you less, and new challenger banks will pay you rather more. And that's either because we have to, or it's either because we have to, or it's because actually we've built very different business models, and that's the whole point of new challengers and competition. It's a better outcome for customers. I can't give you an underlying driver as to why I think customers are saving more.
Yeah.
I can tell you that they're still surprisingly unwilling to move their savings from low, if you like, savings rates into higher savings rates. And either that's a surplus of caution, or actually there's still a lack of confidence about what the FSCS rules actually cover. And one of the sort of chief executives at yesterday's session sort of pointed to the fact that their customers were loyal because they were conservative. But that's all very well when your bank's been bailed out at my expense. And if you signal that you're going to bail a bank out, which I'd quite like if the Bank of England would give me that permission, then clearly customers are going to feel an abundance of confidence. So generally speaking, with an increase in interest rates, there's been more action and activity in savings, which is a good thing, but there's an awfully long way to go.
Do you think part of it's maybe the administrative burden, or people just don't want the administrative hassle?
I think there's part of that. I do think there are concerns about security. The average savings in the UK is hardly something to celebrate. I think that there are concerns about how difficult it will be. Lots of people are still concerned about technology and whether they have the confidence to go it alone. You've seen an industry ultimately that has evolved from a very handheld and advised model, whether it be about investments or mortgages, into a much, much more independent model. And that doesn't suit everybody.
Okay, thanks. And so we're very tight on time. So Mr. Davies and Mr. Bhatia, do you have any comments on those as well?
I mean, just one comment really on the business savings market as opposed to the personal, which is our own focus. I would echo Mark's sentiments there that there's actually far too much cash that's not getting a good deal. We publish research on this, and SMEs are missing out on roughly £9 billion a year in interest against top quartile rates they could get. So there's definitely still a quite significant problem of inertia both in consumer and business markets.
I think a couple of comments from me. Actually, the FCA's Financial Lives report, which was published only a few days ago, is a good read. And what it tells you on savings is that the cash saving penetration is pretty good, but on investing, we are woefully behind. There is a tail, there are edges of cash savings where there are people who don't have enough financial resilience. In our own data, it's a very similar trend to what's been cited. We launched an easy access saver product in November. Healthy rate, 4%. And in a matter of 4 to 5 months, we have seen build out close to 2 billion in that. So that's quite remarkable. It's only open to existing customers. We're also observing a very promising trend for younger users of Starling. We have these products called virtual saving pots. It's not a regulated product, but it's a space in the app. And we are seeing very high usage of that, particularly in younger demographic, which is promising around just fostering a culture of saving. But on the investment side, I think the culture of retail investing is not quite the case in the UK, and I think we know that has been the case for a few years now.
Thank you very much, Mr. Coughlin. John Kennan.
Yes, can we turn to financial crime? And we're quite keen to explore your distinct views, perhaps relative to the bigger banks, or if there is any. Obviously, this is a big concern. We're seeing a massive escalation. We were concerned as a committee to see that the FCA are rather anxious about just seeing slower growth in this. They say it's inevitable it's going to improve. There's been suggestion that because you're digital first, in some respects, you've got a different perspective and a different sort of perhaps expectation of what what's at risk. Could you tell us how you feel about the level of scam and financial crime, and what you think about the APPP reimbursement model that's obviously been active now for 7 months, and if there's anything else you feel should be worthwhile for us to know about? Shall I start with Mr. Mullen?
Very quickly, I'm sure you've heard it before, the banking sector are concerned about the platforms that are the primary originators of payment fraud. And they're not banks, they're not payment services providers, and they don't appear to be regulated to the extent or culpable to the extent that perhaps they ought to be, and they should burden share, given that ultimately they're the source of a huge amount of the loss. In regard to the sort of secondary consideration, the app scam limit is great for customers, because it's a sizable limit, it's broadly matched to the FSCS limit. But it's pretty alarming if you're a startup fintech and you really want to enter this market, because you're faced with a pretty big sort of, most businesses when we started, £85,000 in a single transaction loss would have been potentially catastrophic. So I kind of think there's a balance to be achieved here about who's been regulated and where's the balance, and I don't think that's right.
But you wouldn't want to be marketing yourself as a sort of less secure place to put your money, though, would you?
I don't think that's a particularly beneficial marketing position. No, I don't think that's going to fly at all.
I mean, but you see my point. I mean, either you're going to subscribe to the same model as everyone else.
Oh no, we have no choice.
Yeah,
to be clear, we're a member of the faster payment scheme, so that's that. Right? So it's not a choice that we've gotten. That's basically a cost of doing business as a bank. The questions become whether the banking industry should be bearing that proportion of the cost.
Right,
Nobody's disputing that it's there, and that, frankly, consumer confidence is paramount. But I'm not quite sure that all the players are playing their part properly.
Right. We heard that yesterday. Mr. Davies, would you like to add to that?
So we certainly agree with what Mark said there about that there should be some sharing of this. I'm actually not averse to paying a part of that as a bank. I think it encourages banks to do more, because there has historically not been probably enough done in this space, and it is very much an epidemic. And I think with the the rise of AI tools that allow for much better cloning of websites, deepfake IDs, etc., this can only accelerate unless some serious actions taken. I do think the tech groups have to have some share in that because that's where it originates from. I do think the solution here is data. The problem is any one player, even if you have good technology, you only see one side of the transaction.
Yeah.
It's quite hard to spot. We must put in place national collaboration on data sharing between tech groups, banks, to solve this. And I believe the Home Office is working on something called O3C that I haven't seen the detail of, but it is aligned along those routes. So that must get funded in the spending review, in my opinion.
Okay, a bit to
that's
Chief Secretary.
very clear. Thank you. Is there anything additional you would like to add?
Yeah, sure. Look, first thing to say, the economic crime broadly is a drag to the economy, and if you are a victim of fraud, it is not just a financial loss, but there is an affront to dignity and confidence. And some of the big ticket items come to my desk, and the stories there are quite harrowing. So we support the arguments around information asymmetry and the reimbursement scheme logic. The latest data on PSR leak tables, where it's been an 86% roughly average reimbursement by value. Starling has reimbursed more than 90%. That said, I think the real discussion here ought to be about preventing fraud at source. And you've heard that before. It was discussed yesterday. If I look at our data from Q1, 70% of the fraud originated in tech platforms, many of whom have agreed to a voluntary fraud charter, yet there are unregulated investment advice scams which trap people, and then it is creating an incentive issue where even when we have declared cautioned customers, the mandatory nature of reimbursement does create a moral hazard problem. So I think our focus as a nation needs to be around prevention at source, and that is possible with better technology, better data sharing. For instance, we have applied AI models exactly on APP, where if you were to give them to an army of human agents and ask them to detect patterns, they will do it. But with AI, we are achieving 36-37% more effectiveness in preventing APP fraud. And data sharing with telcos, social media platforms, something which we are very assertively pursuing through coalitions, is one way. But I think there needs to be fraud understanding end-to-end, from origination all the way down to reimbursement.
Okay. Thank you.
Thank you very much, Mr. Glenn. Dame Haire Baldwin.
Oh, thank you very much. Yes, if I could continue with asking you, Mr. Bhatia, that we want to move on to mortgages, and I know that your bank doesn't offer mortgages, and I just wondered if it's something that you've looked at doing and decided not to, or just you haven't looked at doing it.
So we do offer specialized mortgages through a business we own called Fleet Mortgages, which is focused on the buy-to-let market. We are at the moment focused on continue to invest in our transactional banking proposition for 500,000 SME customers all over the UK, and these are really the smaller end of SME, sole traders, entrepreneurs who need a lot of help day to day in staying on top of their working capital and making payments. So that's been our focus. Your on the retail side, we offer an overdraft, and we offer a lot of insights, notifications to guide people on their daily financial habits, and that is our ongoing focus for the moment.
Okay, thank you very much, because we appreciate how important the sector is for achieving this goal of increased home ownership that successive governments have shared. And I wondered at Atom Bank, Mr. Mullen, if what you're expecting or hoping that the FCA will come forward with in terms of your business, because you are in the mortgage sector, I understand.
We are indeed, Dame Harriet. So MMR 2014, FCA came out in 2016 and said, this may be a problem. 2020, they revised the rules. 2025, they come out saying that doesn't appear to have worked. So the first observation I would make is hurry up, please. Yeah, it seems to have taken a long time to conclude that actually too many people are getting advice that don't need it. and actually the cost of mortgages therefore is higher for some customers than it ought to be, and that's a friction and a cost in the market that is avoidable. So the second thing is that, of course, the FCA's announcement is almost in two phases, one of which is we're going to look at the specific advice piece, and then we're going to do a broader piece looking at mortgages. And then on top of that, we're also going to look at the PRA's announcement, we're going to look at the Building Society's rule book. And so if you add it all together, it actually could be quite transformative and important. At one level, it should make sure that people who need advice get advice, but frankly, people who don't. You would say, well, that's a very logical place to get to. But do remember that broker market is the dominant market for new customers, and more than 80% of customers are getting advice whether they frankly need it or not. So that's to be welcomed. The Building Society sort of announcement potentially has broader ramifications because it will increase the competitiveness of the market. Do remember, you've got thousands of mortgage brokers, but there are really only 10 players in the lending market. So one way or the other, this elaborate sort of distribution system will all focus on 10 players. We think there should be more than 10 players. Yeah, we think that actually there shouldn't be such an extreme sales funnel. So whilst I welcome the FCA's announcement...
Just to clarify, are you one of the 10 players?
We are, but we're so tiny that frankly we wouldn't even register on a graph. Yeah, we've got 3.4 billion pounds of loans, of mortgage loans, which sounds, commendable, except in the context of 1.6 trillion pounds of balances, it really doesn't register. So more competition at every level generally produces better prices, better customer experiences, better outcomes, and that's across the whole financial services sector. I think we should be realistic about how much change you're going to see from the advised process. I'm more optimistic about opening more competition through the Building Society handbook announcement.
Okay. Thank you.
Thank you very much, Dee. I wanted to touch on artificial intelligence, something we're looking at as a committee, but obviously, in some ways, many ways, you are at the forefront of technology compared with the more established, shall we say, or the larger banks. And I just wanted to ask if you're, first of all, confident that the senior managers regime means that you're on top of the risks of AI. Are you confident that this is a risk that your banks can manage? I mean, you don't need to go into elaborate on this one, just to test the water, Mr. Bhatia.
Sure. So banks have been, in many ways, voracious users of predictive analytics, subset of AI for a long time. Prevention of economic crime is a well-established use case. I think now, with the advent of generative AI and the improvements we are seeing at an exponential rate, I'm actually very optimistic about the application of AI at scale. At Starling, we are using AI at the moment to augment our 24/7 customer service capability, all sitting in the UK. And we are using AI to help our agents serve our customers better. So I was speaking to someone in our contact center in Cardiff. At the end of a call, when you do a call wrap summary, it used to take 10 minutes. Now with a live large language model, which is running as a customer is speaking, you can do it in a matter of seconds. And the same large language model...
So just to be clear, if I was ringing you as a customer, it would summarise it. You would then send that to me. It's not the one that the customer service representative is reading back out to you, or...
It is for the customer service agent to do a summary of the call. It's called a call wrap.
Yeah.
But at the same time, and this is a very recent deployment, we are we are experimenting with it. The same model can help prompt our customer service agents on potential indicators of vulnerability on the customer.
Yes. Okay.
So there are use cases like that. We are obviously using AI
could you perhaps give a precise example of how AI could spot a vulnerability in a customer? You're obviously using it, and that's quite an interesting...
Yeah, it is a very recent deployment. We are testing and learning. So it would be based on the conversation. For instance, there could be a potential signal of challenge financial resilience, can't make my ends meet, and so forth. And that would flag to our agents to log that. And we have created a tool in our app to log that formally as well. But on the back end, non-customer facing, I think there are many examples of deploying AI to prevent fraud, as I've shared 4. And I think your question about risk, we need to make sure that the existing regulatory framework is adapted to consider risks posed by AI, but I don't see the need for new risk management framework for AI. For instance, there's model risk on the PRA front, and the consumer duty framework creates a broader umbrella to consider the implications of AI. And we are part of an ecosystem where we are having this debate. Our CIO is the co-chair of Bank of England's AI task force, which is designed to have this debate to deploy AI safely and confidently.
So you're not worried about risk. Mr. Mullen, you've got at Atom Bank, you've picked Provenir AI for use. How did you assure yourself that decision was right, and how are you assessing the risk?
It's firstly, we haven't put it in production yet, so
Okay,
it doesn't go into production until September. And we're not using the AI features, incidentally, in September. And we're not using them in live production anyway. So the principal use of AI in that context is to accelerate the test and learn that you need to develop a scorecard. And so you can essentially use a machine to fire greater quantities of data at a scorecard in order to be able to evolve it and make it more refined. And so that's just a much more efficient way of ultimately auto-generating and auto-optimizing scorecards. We've always used scorecards, incidentally, so it's just a new generation of technologies. Banks are actually relatively well placed from a governance perspective to have control of this sort of issue, because we've already got an independent risk function and an independent audit function, and you can call upon that independent assurance to hold people like me or the CIO to account. And we already have, incidentally, because the machine doesn't care, but you can sue a company and you can sue a senior manager. And I think everyone does understand that. We do need to be realistic. Every piece of software that you'll receive or you'll use, whether you like it or not, will come shipped with AI these days. And the same is true of the software that banks are using. And that then creates new challenges to make sure we know where our customer data is. And it's not been served into a large language model that we're not fully understanding of. Equally, if you ask a large learning model the same question with a 10-minute gap between the first and the second, it'll give you a different answer. And that's really new. That's almost human. Yeah, so the idea that when we talk predictive, it's not predictive exact. So we should be realistic. This is new and different technology. It does need to be controlled. But to answer your question, I think there is clarity of accountability. Okay. We all know that we're the ones in the firing line if anything goes wrong here.
Okay. Mr. Davies, do you agree with that? Is there anything briefly you wanted to add?
Yeah, no, I'd agree with that. I think the key point that Mark has made is that these models are non-deterministic. So unlike traditional AI that's been used for a long period of time in banks, these are that you can create different answers from the same input. And I think, therefore, for us, you think about it a bit more like how you supervise a human, because again, humans are non-deterministic. So whereas if you know exactly what the outcome is from an input, you can assure it once, whereas you probably need to treat it more like you're supervising a team of humans if you're deploying AI agents.
And you mentioned earlier that you were using AI as a tool against fraud. Do you want to explain? You probably can't explain too much about that, I don't know, but can you tell us what you can tell us in public about how you
we did both do some work internally as well as we work with vendors. I won't talk too much about it because I don't really want to expose the tools you use, because it allows people to target you.
Okay. But you're finding it useful and it's working?
Yeah, I think 100% I agree with what Raman says, that you can create quite material uplift in the ability to detect fraud, which generally needs to be a real-time activity, as well as then to work alerts that come out of that detection via the use of AI. It certainly is a very good supplement and accelerant to the humans we have, and the humans still make the ultimate decisions for us, but it's that ability to create leverage and acceleration in the work.
I happen to also, as well as chairing this committee, be the MP for Shoreditch, and I do have a lot of fintechs constantly telling me how fantastic their technology is compared with the main banks, who have got apparently, allegedly, buy replacement parts on eBay. I don't know if that's just a Shoreditch tale or is actually true. We should have asked the banks when they were with us yesterday. But you have the ability to be more agile, quicker to adopt than the traditional banks. And do you think that you're at the cutting edge of AI? Do you think other banks and financial institutions have things to learn from you, Mr. Mullen, go the other way?
I think leading edge is better than bleeding edge. So you're dealing with people's money, and it's a really sort of thing not to forget, because they certainly won't thank you for an error when it comes to gaining access to their account or understanding, their financial security and their confidence in, banking is a trust business. Let's not ever lose sight of that. So it's good for us to be experimenting. We have to invest. One of the questions yesterday was whether AI was going to change employment. Yeah, of course it is. I think the person said, there was an ambiguous answer. Of course it is. For goodness sake, it's going to change the dynamics of employment. It's going to reduce the number of people employed, and it's going to change the type of people who are employed. That's going to change organisations. So to be at the leading edge of it is not just to think about it from a customer experience perspective or a fraud perspective, but it's from a total business model and societal perspective. And therefore, there's an awful lot to unpack in it. Right now, we're kind of thinking, are the machines making decisions? Well, yes, but guess what? The machines have been making decisions on a predictive basis for decades. So this is just the next generation of technologies.
Okay. Mr. Davies, anything to add?
I broadly agree. I think anyone in financial services that would like to claim they're right at the frontier of AI is lying. There's maybe
Thank you for candor.
a few thousand people in the world that are working on that, and they're not in financial services. They are sitting in DeepMind in Google or Anthropic or similar. The frontier work is not being done in major banks. I think we're all looking at how you apply that in sensible ways, but yeah, I do think there's a bit of humility around what leading edge of AI looks like, and it's a very small number of people who are doing some very deep technical work.
Mr. Bhatia?
Well, I agree with that, but I think on a relative basis, we have modern proprietary technology platforms. So we are relatively unencumbered by legacy, which means we have cleaner data models. So our ability to deploy AI to help our customers and our colleagues is decidedly better. But we are not complacent. It's something we need to continue to invest in. And on the nature of jobs, this is one area where we are investing for growth. We'll be creating hundreds of jobs in the UK. There'll be different jobs. It will be all about different skills, higher paid jobs, but I think it will be intellectually dishonest to say that the nature of the workforce will not be reshaped by AI over a longer period. And that is a matter of having a healthy debate about skills and learning across the board.
Okay, well,
thank you. Yes, certainly. One last question on this very interesting subject of AI. In the financial services sector in the UK, who is using it in the most effective way that's going to come out as the dominant financial institution because of its use? Is there anyone that you would pick out as being really interesting?
I think it's quite early to say on that.
Too
I
early.
think so in previous technology cycles, they've generally been constrained by hardware. You think about steam engine, electricity, desktop computer, internet and modems, mobile phones. There is no hardware constraint here for most of it. And therefore the speed of cycle of evolution is like nothing's ever been seen before in terms of pace. So I think the extent to which any one institution creates a massive competitive advantage over time, it will only be seen in retrospect. Actually, I think it's too early to tell right now.
And on this subject, do you think our regulators know enough to ensure that the best is achieved through this technology, or are they going to find ways to suppress innovation in this area?
First of all, we're also involved in the AI task force you mentioned. It's great that Bank of England's trying to create that sort of orchestration, and I know the FCA is running various AI labs and so on. So I think some really good efforts from the regulator here. I equally do think the current regulation essentially works because it's capturing the sort of outcomes you need to deliver, irrespective of whether it's a human or AI. So I think in that sense, we have got a lot of safeguards in there currently.
You agree, Mr.
I agree with that. I think there are existing forums in place, coalitions, the task force, and they're all designed with pragmatism and safety in mind. And the existing regulatory framework just needs adaptation for AI impacts versus reinvention of a new regime to regulate AI. And I think that is, by and large, a principle that's well understood so far.
Okay, thank you. John Glenn.
Can I ask one other question as we've got a few minutes? I wanted to go back to this whole issue of the structure of banking in the UK and this concentration that we have. You know, we've seen the sort of consolidation of Nationwide and Virgin. We see speculations over what NatWest might have on their shopping list in terms of other mid-tier banks. So we've got this sort of small number of large banks and a quite a large number of much smaller banks. Now in Germany and the US there's different traditions that have led to a different setup. You know, when you look at this, you're sort of running, it seems, and I think you've made the case for being treated as specialist entities. But can I just understand, you know, do you have anything to say about the sort of beyond what you said about that, you know, specialist unit? Do you think that consumers in the UK are disadvantaged by the way we're structured? And is there anything more fundamental you'd like to say about how we could do things differently?
Who do you want to go to first?
Mr. Davies?
Sure, very happy to. Let me therefore talk from a perspective of businesses, because that's what we do. I'll perhaps leave my colleagues to talk more to consumers as well. I guess on SME, in some ways, has been a big success story. So it's one of the very few markets where the smaller banks now make up the majority of the market share of lending. This is I'm talking about. So that's quite a positive. There are definitely still quite significant issues in the SME finance market. We published some research on that last month, and particularly a sort of combination of move to service sector in the economy and various regulatory and accounting changes that led to banks focusing on very secured lending. I think does lead still to a gap around growth finance and working capital for businesses that's quite significant and needs solving. But I think market structure-wise, there's been quite a positive there. The issue then is, if you've seen a lot of these challenger banks start and get some scale, how do they keep that growing? Because that is fundamental to our economic growth. If those collectively now 60% of SME lending. So I think some of the points we were making earlier are fundamental to the continuity of supply for business lending in the UK. And I do think the trend towards mid-tier firms merging points to this problem with some of what Mark and Raman said around disproportionality, where as soon as you get beyond being very small, you've got to get very big. Yeah. I'm not sure that's a good outcome, market structure-wise, consumer-wise, or even prudentially, because mergers involve quite a lot of risk when it's two entities that are equal size combining.
But it basically puts, you get to a certain size and there's a sort of cliff edge in terms of the cost, and so you basically put a for sale tag on yourselves. Yeah,
you see people often driven by MREL straight ring fencing, looking to put together a 20 billion balance sheet and a 30 billion balance sheet to get to 50, and then another 50, and the 50 gets to 100, trying to get real economies of scale. I don't think that's the best outcome either for consumers or prudentially, because those sort of mergers create a lot of risk.
Yeah. Do you have either of you, Mr. Bhatia or Mr. Mullen, have anything to add to
sure.
that?
I mean, I think on the topic of consumer choice, let's also strike balance in the conversation and celebrate the consumer choice on the back of very progressive sort of outlook from our regulatory regime, which allowed for authorization of banks. We have played a part, along with many others, to drive consumer choice and create competition on really fighting for customer experience. And we see a lot of runway ahead. We have 10% share of the small business account segment, but as we have discussed, there is the squeeze middle phenomenon, if you want to use that phrase, and a good example of that is the MREL thresholds, which we have discussed before, and hopefully that will have a sensible outcome post-consultation, which will allow banks like Starling to really go and create more consumer choice, more competition, and compete effectively with the incumbents.
You'll have to tell us if it doesn't work out well.
We will take you up on that.
Mr. Mullen.
Well, it's a rules-based business. The biggest driver of what banks you have and what they do and who does it and how fast they grow sits with the PRA. You know, and let's all just sort of understand that if the PRA change the rules, you're going to get a very different outcome. So I've spoken about IRB and the fact that they're not growing their lending. Those 10 banks which dominate the market, if you look at their lending and compare it to GDP growth over the last 5 years or compare it to HPI growth, they're shrinking their lending. And they're supposed to be the powerhouses of the UK economy, right? But at the same time, the rules allow those banks unfettered access to the Bank of England reserve account.
Yeah.
The Bank of England reserve account limits were lifted in 2006, global financial crisis. They've never been changed. So here's the thing. If they can get risk-free and capital-free returns simply by putting money on deposit in the Bank of England current account, where's the incentive for them to lend? And so if you want different outcomes, you've got to move the pieces on the table in regard to rules. And you've got to create disincentives and incentives. What is absolutely true is that new competition drives better outcomes. All of the data tells us that. I'm personally not that worried about the sort of debate about M&A. Firstly, the dynamics of a digital business model are very different. You know, you're talking about a different level of capital investment to get really big than was the case even a decade ago. So I think there's a lot to go at here.
Can I just pick up on Mr. Mullen's point there about there are voices in this Parliament that argue that banks shouldn't be paid bank rate on their reserves, they should be paid substantially less than that, and that the money should be spent on public services. What's your view on that proposal, Mr. Mullen?
I think those are sensible questions to ask. I think because that rule was changed in 2006 of the global financial crisis and you now spin forward to 2025, I don't think anyone should be afraid of asking that awkward question. At the end of the day, if you're a bank and you have a banking license, the first question we should be asking is, why do you give people banking licenses? Do you give people banking licenses so that they can play an arbitrage game between what they pay savers and what the Bank of England pays them? That's not value adding to any economy, let's be really clear. You give people banking licenses because they're leverage engines. And they're leverage engines that should be lending. And ideally they should be driving growth in GDP and lending ahead of the rate of inflation or ahead of the rate of HPI. And if they're not doing that, you should raise a legitimate question about what are they for? And why are you subsidising them through the Bank of England? Because frankly, if they're not adding value, I might ask the question, why can't I just save directly with the Bank of England, please? Because you're a middleman, what value are you adding to it? And I can buy the argument that you're driving growth, because that's actually for the greater good, but I cannot buy the argument that you should have unfettered to a service that incidentally I'm paying for, because when last I looked, I own the Bank of England, and so do you all. So this is a choice that we're not getting to make, as far as I'm concerned. It's a policy that's just been enacted.
So you're governor for the day, would you change it?
I'm not an economist and I'm not a monetary policy specialist. I would absolutely want clear and unequivocal answers about why we think this is in the best interest of the UK.
Perhaps we'll write to the governor and ask him.
Yeah, just trail the governor is in front of us, certainly in July.
If I may just add very briefly on the topic, I sort of agree, but only sort of.
Governor for the day, Mr. Davies.
I think maybe needs to be a threshold. I think at the margin it is important in monetary policy transmission, but also, so speaking from a fintech lens, there are players like, say, Clearbank, whose only purpose is to help provide clearing services to other banks, so we use them to connect to faster payments and chaps and backs. Now, in order to almost promote their safety, they say they don't lend the money out, they'll only hold it at the Bank of England. And that's sort of a good thing, because they're not a huge institution that otherwise we'd have to have quite a lot of concern about. So perhaps there's sort of a de minimis carve-out that a few billion is okay, but 50 billion is not okay, because I do think there's a role for that sort of institution in the ecosystem.
Okay.
Thank you very much.
Thank you very much indeed. So thank you very much indeed for your time. The transcript will be available on the website uncorrected in the next couple of days, and with major thanks to our colleagues at Hansard for that. It's been really interesting to hear from you. Obviously, we heard from the building societies that even for a sector that prides itself on being owned by customers, Consumer Duty has driven change there, and they're concerned about ISA limits and that financial education and advice are important. And we heard from you really concern that you're hitting burdensome rules as you grow. I mean, we've had quite a lot of discussion about that, something that I think we were aware of, but thank you for amplifying that point. And that changes to mortgage rules, I think both you and the building societies agreed, could be transformative. So that's interesting to hear. I'm sure, hopefully, the government is listening to what's being said here. And that we had a really interesting discussion about AI and how that's being used, and we are doing an inquiry into AI in financial services, so we're keen to hear and really test the waters about how that is being played out. So can I thank you very much indeed for illuminating a number of those issues, and look forward to hoping that you will give evidence to future inquiries that we do, because it's important that we have perspectives from the whole financial services sector. Thank you very much indeed.
Thank you.